and this is a bad decision, right? That fund is up like 17x. Okay, 17x. That's great. But if I put in the Bitcoin fund, I'd be up 350x.
Yep.
But I didn't do that. Interesting in air quotes, JT. No, it's been amazing, and I'll try to do short. I don't do short well.
That's fine.
I'm old, right? That's the first thing. So I've been around a long time, and I came out of the traditional world first managing endowment money. So I worked at my alma mater at Notre Dame, and then ran the endowment here in North Carolina at the University of North Carolina at Chapel Hill, and then almost 20 years ago started a company, Morgan Creek Capital Management, that would bring that model of investing, broad diversified asset management, use of alternatives across other investors. So individuals, smaller pensions, endowments, et cetera. Did that for a long time. And one of my big things, back in 2000, I was labeled the Madonna of hedge funds. What does that mean? I'm a guy, not a woman. Well, it was that I was always up on stage at conferences saying that institutions needed to invest in hedge funds. You needed to get hedged, that the markets were super overvalued. You needed to use downside protection. And so when the markets cracked in 2000, 2001, 2002, we actually were able to be dead flat over that 3-year period because of hedge funds. And so we backed a lot of hedge funds over the years. And most notably, a guy named Dan Moorhead, who runs a firm called Pantera, everyone's heard of, in the crypto space. And Dan came out of Julian Robertson's shop 20 plus years ago. We were his first institutional check, and he ran a macro fund. And I'm a macro guy. So I'm part of what I call the OMGs, the old macro guys. So myself and Dan Tapiero and Paul Tudor Jones and all these old macro guys who have suddenly found Bitcoin and digital assets. And long story short, Dan said, hey, come to San Francisco. It's 2013. And full disclosure, right? First of my many bad decisions. I mean, I was introduced to Bitcoin the same month as the Winklevoss twins. They are multi-billionaires, and there's a book written about them, not about me. Because I was skeptical, right? Dan brought me out to San Francisco. He said, hey, I'm going to spend the rest of my career focused on Bitcoin and blockchain infrastructure. I'm going to shut down my hedge fund. I said, why would you give back $1 billion charging 2 and 20? And he said, oh, this is an amazing thing. Look, I was not running drugs on Silk Road. I was not a cryptography student. In 2013, I'm like, Bitcoin, I heard of it. I don't get it. I don't have any. I didn't buy weed with it. I don't know what you're talking about. And so he said, all right, fine, don't worry about it. But infrastructure, and look, infrastructure, I get. And I've been very fortunate in my life, again, series of happy accidents. So in the early 90s, we invested in a bunch of venture capital funds when I was at Notre Dame that became brand names, Kleiner Perkins, Sequoia, et cetera. And we put $500,000 into this little company called Google, which at the time seemed like an idiotic idea, stupid name. Now it's a verb. And there were 20 search engines. Why do we need 21? And what we didn't get was that Larry and Sergey had this way of creating a better way of doing search. And then they had a better way of tracking us and everything we do and monitoring every part of our life and become a $1 trillion company. But we took out $200 million from that 500K. So we made a lot of money for the university. And I had this aha moment that infrastructure, I told you I suck at short. So, okay. So I made investment in
so you're telling a great
Dan was
story.
going to do infrastructure. And I said, all right, I'm in. And this is a bad decision, right? That fund is up like 17x. Okay? 17x. That's great. But if I put in the Bitcoin fund, I'd be up 350x.
Yep.
But I didn't do that. And so 9 months later, I had finally done a little bit of work. And I wrote to my clients that they should look at Bitcoin as a special situation. They should put a little bit in, 25 basis points, 50 basis points. I used to write these long letters. It was 40 pages, one paragraph saying Bitcoin is interesting. I got hate like, I'll fire you. You're an idiot. Don't talk about this. Go do your job. You're supposed to be focused on hedge funds and venture capital. Go do that. Wow. I said, okay, fine. And price went from $500 in March of 14 to 186 by September. I'm like, oh, look, they were right. And then 8 weeks later, it's $1,000. I'm like, no, they are not right. There's something here. And so I did more work. And literally my son was graduating from college. He wanted to live in San Francisco his whole life, be in tech. I said, one word, not plastics, like The Graduate, one word, blockchain. Go get a job in blockchain. I sent him out to talk to Dan. Dan introduced him to people at Coinbase. I was like, I don't know, Dad. Maybe this can be a big deal. I'm going to go to KPMG. It's safe. Gets me to San Francisco. I'm like, you're going to hate it, which he did, quit after 9 months. And when they went public, he called me up and said, Dad, all right, fine, you're right. I should have gone to work at Coinbase. But you're not as smart as you think you are. I'm like, I didn't tell. I told you to work at Coinbase. It's like, yeah, but you didn't lever up the house and put it on Bitcoin. Okay, totally fair. And so that was 2015. Finally, in 16, I got some of our clients to say, fine, you badgered us enough. We'll buy some stuff. I bought a little Bitcoin, a little Ethereum. And then a year later, I decided I was going to raise a fund. And so I had met these two young guys, well, not that young, but Pomp and Jason. And I met them totally random, right? We were doing an investment, Lyft, we were big investors, Uber and Lyft and DD and all the ride sharing. And we had met for 15 minutes. I thought they were nice guys. But then I started following Pomp on Twitter. I kept hitting like. Everything he says. That's something I would say. That is something I said. I need to meet this guy. So we met for breakfast at the end of 2017. Breakfast turned into lunch, turned into dinner, turned into the next day. We got to do something. So we cooked up this idea to create Morgan Creek Digital, which we formed first quarter 2018, went out to raise a venture fund, and we got lucky. We had a visionary CIO, two CIOs at Virginia Retirement System, give us $20 million. We raised another $20 million, raised a $40 million fund. And we made a bunch of great investments. 85% of the money went into companies, 15% went into protocols, Bitcoin, Ethereum, through multi-coin capital. We got some Solana and some Graph, and the fund's done great. We raised a second fund in 2020. We're raising a third fund right now. Anyway, that's way longer than it's definitely never too late. And here's the thing. What people are missing about what's going on is this is not a thing. This is not Beanie Babies. This is not baseball cards. This is not some fad. In fact, that's my thing. Hashtag probably a fad with a little rocket ship. I tweet that out all the time. It's not a fad, right? And it's sarcasm, right? It's total sarcasm, by the way. When people are like, what do you mean it's a fad? I'm like, guys, it's sarcasm. Maybe I need a little, winky face. But here's the thing. This is an evolution of technology that is as incontrovertible and inevitable as the internet, as the mobile net, and this has been going on for 70 years. This is not a new thing. And it has to do with computing power and the evolution of computing power. And it's been my life, right? My dad sold IBM mainframe computers. And this all started back in 1954 out in Boston, right? Not Silicon Valley. Boston was the center of the universe where JT is sitting right now. And out on Route 128, there was this little company called Digital Equipment Corp, founded with $70,000 of venture capital. And they started making computers that were as big as a house, but now a company, not just a government, could have a computer. And, other companies, Wang, one of my favorite names, and, IBM and all these other companies were built, and they were real businesses, and made a lot of money investing in those businesses. 14 years later, there was an innovation out in Silicon Valley around DARPA, this invention of the microchip. And these little companies like Fairchild Semiconductor and Intel, you might have heard of it. And this guy, Don Valentine from Sequoia, invested and made a bunch of money. And then 14 years later, and why it's always 14 years, that's to do with young people. Young people invent everything cool, right? Because old people can't imagine the unimaginable. Young people don't know what they don't know. And so they're willing to imagine the unimaginable and build things. So Mark Andreessen, when he built the browser, 19 years old. Larry and Sergey in their 20s. Bill Gates looked like he was 14. You ever look at the picture of the original Microsoft 11? which I always used to defend myself. So 1982, personal computing. And I grew up in Seattle. And a lot of my friends don't have to work anymore. They went to work for that little company. I would say, if you've seen the picture, the original 11 people at Microsoft, you wouldn't blame me. Now, they're all multi-billionaires and I'm not, so I should not make fun of them. It's a common theme, right? Lots of multi-billionaires and not me. But the interesting thing is Steve Ballmer's mom, quoting the guy from DEC, right? DEC had become the incumbent, and personal computing, he said, no one would ever want a computer in their house. Right? Charles Darwin said there's a maximum need globally for 100 computers. 100. And Charles Darwin's a pretty smart guy. But the incumbents can't see the change that's coming. And so Steve Ballmer's mom said, honey, why don't you go to work for that company? Well, he has 18 billion reasons he was right, mom was wrong. So 14 years later, we did that investment in the internet. Remember Bryant Gumbel saying, what is internet? What is that @ symbol? And Paul Krugman said, it'll never be more important than a fax machine. Yeah, right. It's more important than a fax machine. Trillions of dollars of wealth created. 14 years later, I'm actually back in Seattle at Craig McCaw's house. Craig was a famous investor in cellular technology. And I asked his family office guy, do you think the mobile net will be as big as the internet? He's like, Mark, you kidding me? Ask people if they want a computer. Like, whatever. Ask them if they want a phone. They're like, I already have 2. I don't need another one. Yeah. The mobile net will be bigger than the internet. And the mobile net, Web 2, created unbelievable, untold wealth. First multi-trillion-dollar companies, way more wealth than Web 1. And it's all about exponential growth. Think of an exponential curve, right? It goes parabolic to the x-axis, then the other curve, and then it goes parabolic to the y-axis. And the thing is, people suck at math. Like if I say to 3, what's 2 times 2? I'll say 4, okay? If I say what's 17 times 23, and I say, oh, wait.
We're stumped at that point.
That's the limit of human intelligence, right? The average human being cannot do 17 times 23 in their head. They need a calculator. And so if I say, how are you at nonlinear logarithmic regression? You say, I suck at that, right? Or the fact that if I take 20 linear steps across my library, I get to the other side. If I take 20 exponential steps, I get to high five JT twice. I go around the world twice, all right? And so people just can't understand exponential growth. And so the exponential age, which is all about Metcalfe's law and networks, is all about how we went from computing on machines to computing in networks. And the biggest, most valuable things in the world today are not companies. Amazon doesn't make anything.
Yeah.
Right? They are a search engine that matches buyers and sellers. They are made valuable by the network, right? If 2 people talk about financial literacy, it's a nice conversation. But a network of people engaged in expanding financial literacy creates change for good, change for the world. And so networks is what it's all about. And now we're at this point where blockchain technology is the operating system for the Internet of Value. And again, the mind-blowing thing is for thousands of years, the church had a monopoly on information. And the printing press came along. Remember, literally, you went to church on Sundays. Most people couldn't read and write. And you were given your beliefs by the person in church. They told you what to think. They told you how to think. They told you when to think. And then the printing press came along. And suddenly, I don't have to think that. I got this book. Now I got to learn to read and I got to learn to write. But it changed the world. So then governments took over that control. And through state-sponsored media, either state-owned, like China or Russia, or state-sponsored, like ABC, NBC, CBS, where it was 3 networks but the same, propaganda, that state had control of information. The internet busted that monopoly wide open.
Yeah.
Like I use the example of Argentinian elections. If I want to know what's happened in the Argentinian election, the old days, I waited for the reporter to fly to BA, write the story, send it back to New York, have it edited. 2 days later, it comes out in the Times. I read it. Oh, cool. Now, I go on Twitter, I go to Periscope, I watch people standing in line live for 2 hours chanting Macri's name, like he's going to win. And information became bi-directional for the first time ever. Now, value is bi-directional. We can take anything of value, money, property, anything, right? A JPEG, a piece of art, a collectible, a case of wine, a car, anything of value can now be digitized, can be made a token, an entry on a ledger, public, immutable, secure, and can be exchanged anywhere in the world instantaneously with no middle people. That creation, that evolution of technology will create more wealth than all the other wealth creation opportunities that came before. This is the exponential part. This is the asymptotic move to the y-axis. Web3